Thank you, Nick, and good morning, everyone. Today's agenda really for the Australian market scene is for me to take you through the key macro drivers of the Australian property markets, because I think that's important to set a benchmark in our expectations for the year ahead. We'll then actually call on a panel to come to the stage for the second half of the presentation, where we drill more into the issues surrounding the Sydney market by sector. The theme I've determined for the Australian scene really is adjusting to lower growth. And the reason I say adjusting to lower growth rather than adjusting to slower growth or slowing growth is that there's some fundamental shifts we've seen in the Australian economy that have lowered the trajectory of growth, and we expect that's going to remain entrenched over the next 12 to 18 months. So while we think that growth isn't slowing anymore, we do think we're locked into a lower period of growth, and that the markets have effectively priced that in. You can see that across the equity markets, you can see that across the property markets, with much lower growth expectations embedded into capital values. The first big theme really is deleverage, higher savings, and as I said, lower growth. These things aren't disconnected. When we enter a period where confidence is low, debt appetite is low, balance sheet growth tends to slow. We replace debt with equity on balance sheets, but expectations for growth driven by leverage actually decline. So that gets reflected and built into markets. I think we've gone through that adjustment phase now, but at this point in time, given where confidence is at and given all the uncertainties that Nick's presented today, that's unlikely to dissipate over the next year. A very common theme we've had in the Australian marketplace has been the sector and regional divergence. We often hear the term multi-speed economy and so on. I was determined not to use that today, but I already have. The main point there is that we've always had a multi-speed economy in Australia. New South Wales, for example, has always grown around 0.7 to 0.9 times the pace of the national economy. If you look at that over the last 3 decades, New South Wales has fallen from about 36% to 31%. But it's still a relevant investment. I'll go through some of those themes today. As I mentioned, higher yields on risk assets have been a predominant theme due to that subdued risk appetite. And there's a global transmission mechanism at work. So the uncertainties in the world that Nick has presented actually come through the Australian market via our reliance on wholesale funding globally. So those risk premiums that emerge from the offshore market actually are transmitted to Australian asset classes via bank lending rates, which I'll go through today. And the interesting point, if we look at space markets within property, so we look at demand and supply, things actually look quite balanced at the moment. So we've had relatively low levels of supply coming through over the last 3 years, and that's really helped to compensate for, I think, the softer demand conditions that we've seen. If we look at deleverage as a concept, so effectively what we see in the Australian economy, that savings rates have increased significantly within the corporate and the household sector, to the tune of about $70 billion in each sector. So that's a lot of credit that's being replaced on balance sheets. And believe me, it's being replaced. It's not actually growing the balance sheet, it's actually replacing debt on balance sheets. So we've seen a much slower credit growth environment, and on the back of that, building in much lower growth expectations for the market. Obviously, the direct impact of a higher savings rate is a reduced consumption rate. I think the key point to make here is we always focus on retail sales being a very soft component of consumer spend. You can see from the right-hand chart there that retail sales are actually growing at about 2.5% in annual terms currently, versus overall consumption spend of 6%. But retail has really been squeezed by the other components. So we're spending more on health, on education, on rents, on property. Those components are actually squeezing retail. The key point is that consumer spend now at 6% is now in line with income. And you can see a big adjustment in the left-hand chart that happened in about 2008, 2009 when the savings rate picked up. That was when retailers were actually feeling a lot more pain because the growth rate of their sales was falling from something like 6% annual, which they'd been used to over an extended period of time, to this 2.5% level. The good news is, as I said before, a lot of these indicators are bottoming. So retail sales have grown at about 2.5% pace for the last 6 months, appear to have bottomed now. So our central hypothesis is that we think the worst is over for consumer, We think the worst is over for retail, albeit much weaker than the environment we were used to previously. In those sort of conditions, it's interesting, the economy you would normally expect would fall very close to and into recession. There were two responses. There was the public sector was in a position to actually move into deficit after a decade or more of surpluses, but the key influence has been the increase in investment. And that's not a new picture, and it's expected to continue. I think the main thing for property markets that's interesting in this, though, is that the level of capacity expansion outside of mining has been flat over the last 3 years, and the expectation is it will be flat over the next 2 years. So investment in mining combined with increased government spending has actually helped Australia avert the recession and offset that move to deleveraging. A lot of the countries overseas didn't have the benefit of that or the flexibility in their policy settings to achieve that. I mentioned supply is generally low, so if you break down that component of non-mining capital expenditure, you can actually see that commercial building approvals across office, retail and industrial are at decade lows. So we're back to the levels that we were experiencing in the early 2000s. In a way that's saved us because it hasn't created a great imbalance given the demand conditions we've had. We haven't had a big stock and bubble of supply that needed to be absorbed. So it's actually helped support property markets in the last couple of years in terms of rental growth we've seen in office and improvements in industrial. The other component, which is always a very good leading indicator for consumer, is what's happening in the housing sector. And I think the critical issue with the housing sector is that we're still running at about 33% below levels of early in the 2000s. So building activity is very weak in housing. It's not a new story. It's not supportive, but it's flat in New South Wales. I think the key move that we've seen in Australia has actually been the downshift in Victoria. And if you look ahead into forecasts for the Victorian economy, housing actually helped during 2009 and 2010, but Victoria is slowing quite significantly this year because the housing sector's softened a lot. It is still, it still does have the highest level of activity though across the Australian markets. So if you actually combine all of that, it creates this very uneven growth story. And the forecast, you could look at any forecast, but if we look at Deloitte's forecast, you'll see that WA and Queensland still stand out as the major growth economies. As I said earlier, that's not a new story. New South Wales is always growing at what I'd call a 0.7 to 0.9 economy, so it's always growing at that pace slightly below the national average. The key thing about New South Wales, or maybe the key question is, why would I invest in New South Wales? Why wouldn't I invest in WA and Queensland? They're the growth states. To an extent, that's true. But when you actually look at the volatility of those economies, it's almost twice the volatility of New South Wales. And the chart on the right actually says the correlation of New South Wales with the other states. And you can see for Queensland, it's about 0.5, for WA, 0.25. So including New South Wales in a portfolio is actually very important from a diversification perspective. Investors will pay a premium for that in a diversified portfolio. The other element of growth differentials that we've seen, which is very important for what we're seeing in industrial at the moment, is we're seeing a lot of growth in what I call the middle sectors of the economy. So between manufacturing and retail, we have some issues in manufacturing, we have some issues in retail, but we are getting a lot of growth in wholesale and transport. There's various theories around on that. The high AUD, higher import levels are certainly helping, probably more so than what you'd read about, which is suggesting that internet activity is driving a lot of this, but it's actually more about higher AUD, some stockpiling inventories, bringing in more imports in these conditions.